Well, we certainly hope you're going to give us some good advice tonight. The time is 8
Hope
o'clock.
so.
We're going live in exactly 2 minutes' time. Well, want to welcome Steve Herring back on. Steve, of course, you play in a completely different space. You play in the property space, do you not?
That's right. We've been going just over 20 years, and today we're a REIT listed on the JSE. So we've also had a lot of fun along the way, and we think we're just warming up.
You're just warming up. Are you having fun at the moment, though, is really the question.
We still think there are opportunities out there. So although it's become more difficult, those challenges bring opportunities.
That's absolutely amazing. So welcome. We're currently being watched by about 1,200 people who have tuned in. A great welcome to you all. We'd love to know who you are and where you are in the world. So please, in the chat section at the bottom, please say hello to all of our panelists. Please tell us where in the world you're joining us from. We see recently we've had a lot of viewers joining us from the United Kingdom, from France, from places like Brazil, the United States, Canada. We have some very dedicated viewers in Pakistan, Australia. We've had Costa Rica coming on. We've, of course, got people right around South Africa. So a huge welcome to the people from Cape Town. I hope you're having better weather than the videos that we've seen on the last few days. Welcome to the people from New York. Nice to see all of you coming in there, and Florida in the United States. We've got people in Ballito and Durban coming in, as well as we have Joss in Nigeria. A huge welcome to you from Nigeria. And Glenazel, I see we have Liron from Glenazel, and we have from Pam Bender, hi to my zebra and ex-friends, and hello from Santon. And some people tell us Cape Town is freezing at the moment. The time is exactly 2 minutes past 8. A welcome to all of our panelists, and especially a huge welcome to Dina Diamond on behalf of the South African Jewish Report. Dina is one of my co-directors of the South African Jewish Report, and it is a great privilege that tonight we bring you, I think it's our 36th panel. Dan Stillerman, are you there to tell us, are you counting the numbers?
I am. It was a bit of a trick calculation this evening because it was link number 37, but it's event number 36. We've got some other exciting events coming up. So glad to be here once again. And good evening to you, Howie, Dina, all the panelists, and everyone watching at home right now.
And Dan, you're going to be tweaking all the knobs for us tonight. You're going to be bringing people on and off. You'll be showing videos, taking down videos. You'll be showing graphs and making sure that tonight runs like a oily, smooth machine.
Absolutely, Howie.
And Dan, are you using your new Shure mic tonight?
I am not. I have to be honest. I've got it here. It is my first choice, but tonight I'm using my second choice because I was having a bit of issues earlier with internet, load shedding, all of that. So I just didn't want to overload the system.
So people asked me if I was feeling okay after our last broadcast. I'm using my new Shure mic over now, and I should be sounding enormously professional, and in my spare time I may become a singer because now I have all the correct equipment. So a huge thank you to Shure. I'm also wearing my Shure buff so I can rob a bank or maybe a hedge fund tonight. But on behalf of the South African sorry, Dina?
You're wearing it just like the president.
Exactly. But on behalf of the Jewish Report, a huge thank you to Dan for everything that he does for us. You are the king of investments, and you're an actuary as well. So let's hope you'll be chirping in and looking at some of these figures and telling people where they make sense and don't make sense.
Absolutely. I'll try my best.
Great. Dina, before we begin our panel this evening, there are a few things that we need to tell people about. First of all, a huge welcome to the approximately 1,400 people who are watching us already. Lovely to see you here. At the bottom of your screens, we tell you, as we do at every broadcast, you will see a number of buttons. Use the chat button to talk amongst yourselves. We love to watch you chat. So please talk to each other, post comments, questions, but the questions that you want the panel to answer. Don't use the chat functionality. Remember, there's a Q&A button at the bottom over there. And that's where you actually put any question that you'd like to ask any of the panelists. So we'll begin this evening by asking each of the panelists specific questions, but they'll all be coming back at the end, and you'll be able to pose any investment question you like to any of the panelists, but we will only be looking at the Q&A button at the bottom of Zoom. And Dan will also be looking on YouTube at the comments on YouTube as well.
And we've just activated the upvote and the commenting on questions. So if you want to comment or answer somebody's question or upvote a question so it comes out top of the list, then you can do that in the Q&A as well on Zoom.
Fantastic. But Dan, we also want to tell people we've got a number of remarkable events that are about to take place. So tonight is Wednesday night, and our next new Zoom event will be on Saturday night, which just so happens to be Mandela Day. And we are absolutely honored to be hosting Judge Albie Sachs and Rory Steyn as our guests on Mandela Day at 7:30 on Saturday evening. Now, many people may know the name Rory Steyn. Rory Steyn was, in fact, Nelson Mandela's bodyguard and looked after him throughout his presidency and afterwards. And Rory Steyn is going to come tell us some very unique and some very personal stories about Mandela, what he saw with Madiba, the people they experienced, the danger that he was in, and the fact that here you had someone who was willing to take a bullet to protect Madiba's life. And he has written the most engaging book about our former president, and he's going to be telling some unbelievably personal stories. Also joining us on Saturday night is Constitutional Court Judge Albie Sachs. Now, many of people will know Albie. Albie's father was, in fact, Solly Sachs, probably the most famous trade unionist in South African history. Solly Sachs was, in fact, the head of the Garment Workers Union. His son, Solly, went into exile, was a lawyer. While in exile, the apartheid government blow up a bomb. He loses his entire arm. He's lying in hospital. And he says, what's the first thing that you wake up after a bomb blast? You check. Do you still have your testicles? And he reaches down to feel, and he does. But then he realizes he's lost an arm. He can't feel anything at all. And he's going to be telling amazing stories about his life, about his time in exile, about being blown up, about his return to South Africa, his role in writing the Constitution, as well as becoming a judge of the Constitutional Court of South Africa. It will be one of the most inspiring, remarkable evenings that you will ever have. So 7:30 Saturday evening on Mandela Day, we will see you for a remarkable evening of stories about Madiba and stories that will inspire you about South Africa. So that's Saturday night. But Dan, we have a little video that we'd like to show people about what will be happening on Thursday next week. And this, we're so excited.
Okay, so give me a moment. Let me just find the video quickly.
Okay, fantastic. But come, in fact, the 23rd, Thursday the 23rd, please mark in your diaries because we have something uniquely special. Anyone who watches Netflix will understand what we're about to show you.
جاي حفلة ليه لا؟
بفكر في الموضوع.
Mañana già abbiamo mucho lo scopo di questa. Il banco per come comando me odio manin.
רוצים לפעולה משותפת עם הימ"מ. ולכן ברור, חברון זה לא שטוב. Welcome to עזה.
اليوم بكسرك. في شخص جايبي وريحته طالعة.
كيف قطعته؟ للبحر.
So on Thursday evening, I will be interviewing Ala Daka, who is the boxer, the main character from season 3 of SAJR. So please join us then. I think it will be an astounding evening that everyone will absolutely, absolutely enjoy. And that's coming up on Thursday, the 23rd. We'll be sending out the links to LB Sachs and Rory Stein tomorrow. And we'll be sending out on the weekend links to our Ala Daka SAJR webinar, which will be taking place next week. And with all of those advertising, Dina Diamond, on behalf of the Jewish Report, a huge welcome to you. Thank you for hosting tonight's panel, and I hand over to you. You're on mute, Dina.
That's always a good way to start a webinar. So thank you so much, Howie. Yeah, so for any of you any people who have not seen Founder, you can quickly binge watch it, because by the time you catch up and you actually watch that interview, it will be phenomenal. So I would strongly suggest getting onto Netflix after this webinar and binge watching. Alrighty. So this evening, the way we're going to run is we're going to go through each of our panelists. We're going to do about an 8 to 10 minute chat and on their sort of speciality and skill set. And then we will be having a Q&A at the end. So there will be questions that come up, but don't worry, they will be answered and we will be taking the full panel at the end. All right. And the first person that we are going to be starting with is SAJR Jacobs. So I think the rest of our panelists are just going to be sort of their videos should be off soon. And we will be bringing up SAJR Jacobs. SAJR, good evening.
Good evening, Dina, and good evening, Howard and Dan. And thank you, Jewish Report, for this opportunity. Look forward to talking to all of you tonight and hope that I've got some words of inspiration on investments.
Fantastic. Where are you coming to us from?
Coming to you live from Morningside, a very cold study, as you can see. So I am wearing a jacket, but look forward to the chat.
Marvelous. All right, brilliant. So, SAJR, as you mentioned, you run sort of one of the biggest hedge funds in South Africa, and obviously it's been a very trying time in the markets. We've had the whole onset of COVID, but you have consistently outperformed as a hedge fund. What is it that actually keeps you guys ahead of the game? What is it that you think is sort of your secret formula to always producing outperforming returns?
Well, I think for a lot of the listeners here today, I think many people are unaware actually what a hedge fund is and what it does. And I think it's important to put that in context compared to a normal portfolio or a normal unit trust. So in old days, there was a normal unit trust consisting, let's say, of a whole bunch of shares. You invested in that, and if those shares went up, your fund went up and you were effectively worth more money. Today, really a hedge fund is like a bi-directional strategy, where basically you can invest in 2 different ways. Yes, you can buy shares and hopefully those shares go up, but you can also kind of target shares that you think may go down. You borrow shares from a pool, you sell those shares at a price, and you hope to buy those back at a lower price. So you actually have 2 different pockets of profit opportunities. We combine them in the same fund, and we hope that the combination of the 2 really generates a return that's much greater in a normal, what we call long-only portfolio. And at 361, we've done this successfully for 15 odd years. We've managed to generate a return of almost twice the market per annum. So I think we're running at about 16% per annum net to our investors. And a combination of that comes from the short positions as well as the long positions. And we just feel that that kind of portfolio protects you better, especially in this type of crisis. In a market that we've seen over the last few months, a hedge fund type strategy has kept your money intact. In fact, our funds lost nothing into January, February, March, while the market was down some 35%. Our hedge fund was in fact down 0. And it gives you an opportunity to gain good traction in good markets and protect the fund in bad markets.
So how has your investment strategy changed at all in the current environment with COVID and looking at the global outlook and the South African outlook?
Well, I think, coming into the crisis, we were fortuitous or maybe had some good vision in seeing that the crisis had unfolded quite quickly in China. At that stage, we actually took a decision in the hedge fund to buy some derivative protection, which is in fact very much like an insurance policy. And that policy really protected the fund into the massive downturn we saw in March. So as a result, we probably were a little bit more cautious into this environment than we have been, let's say, in previous bull markets. But I think over the years, specifically the last 5 years in South Africa, post 2015, we have generally adopted a lot more cautious approach to markets. There have been industries that are not performing well. I mean, it's clear and evident what's happened to retail, banks, industrial companies. We're going to hear from Stephen Herring a bit later, but the property sector, I had a look the other day, was down some 70%, from its 2007 highs. So there has been a lot of struggling companies and industries within South Africa. And as a result, a hedge fund strategy has been a lot easier to deploy in this type of a market, because you've got those industries doing well and you invest in those, and you've got the ones not doing well, which we also make money from. So the strategy has, I suppose, got more conservative, and over time has unfortunately found more opportunities on the short side. We've also seen, obviously, some big crises in many companies in South Africa, where what we thought was real wasn't real. So the likes of a Steinhoff or Resilient and Fortress in the property space, some big companies like EOH that have faltered or break, and all these are things that we never saw in previous bull markets. So I think that the bi-directional investment strategy has given clients a much better return, much more safety, and I think that asset class is gathering a lot more traction than your traditional long-only portfolio.
Okay, and you mentioned, obviously, Will Steinhoff, that no one could have seen that coming, and obviously lots of money was lost around that. But at what point do you decide to take your losses? So you say, so obviously you've got like points that you decide that you're actually going to sell out, or do you think you actually go short on that? What is your strategy with that Steinhoff particularly?
Well, in fact, Steinhoff, and someone actually asked me the question today on Twitter, which is quite interesting, what I thought of Marcus. And I think it's interesting, if you went to Marcus Jooste today and you asked him which investment manager he disliked the most in the entire market, I would guess that 361 would have come top of that list. From early on, as early as 2009, when Steinhoff bought JD Group, we began to question many of the financials, many of the accounting policies, this great foray into furniture on credit, with big leverage, and even some of these underlying subsidiaries and their performance never made sense. So to us, unfortunately, we were a little bit early. So actually we lost money on our short for many years, and the money we made at the end when Steinhoff finally collapsed wasn't that large. But those are the types of companies where if you do get those right, and we have had many that we've nailed properly, like African Bank, or many in the property sector that Stephen Herring would know about. But I think those add a different dimension to your investments, and give you that opportunity not only to protect the companies that you invest in that you're hoping are going up, but also to make obviously extra profits when you time those correctly.
Yeah, and how do you identify those shorts, the companies that you think actually are going to be going down?
Yeah, so we have like a checklist of various things we check against the companies. For us, a big, and we call them our red flags. So red flags in companies today are often companies, for example, with huge accounting profits, but very little cash flow. And let's say there are a lot of revaluations in the businesses, a lot of subjective accounting methodologies. But when you look through the cash flow, you don't see the corresponding cash making up the company profits. We saw this to a large degree over the last number of years. We've also seen management who obviously aren't in many cases incentivized along the same lines as shareholders, in which case we always get wary as well as to what their true objective and incentives are. We've seen companies, for example, that only have exposure to one client, like government, and then we're always concerned that there could be potential kickbacks or bribes or possible problems. And over the years, we've just found that there are many other, call them red flags, that just stick out in many companies, and we hone in on those. And I think honing in on management and the independence of a board, and understanding their history and their strategy and where they've been consistent over the years is very important to gauge whether they'll be really honest in what they're doing going forward.
Yeah, so with that in mind, which industries do you think are basically the top industries going forward, and which are the ones do you think we should be avoiding, considering everything that we're in at the moment?
Yeah, so I think in South Africa, we've obviously got a big crisis. I mean, we've had no growth for a while. We've been downgraded. I think that the lucky thing for investors in South Africa is that the stock market doesn't actually represent South Africa. It does in half of its investments, but in the other half, it's really defined by what happens globally. And I think we're more on the side to invest in those stocks that have global exposure. Our biggest and greatest investment we've ever had has been Naspers. And I think for everybody sitting here, somehow in a direct or indirect way, they've benefited from Naspers as an investment. Many pension funds, retirement annuities, unit trusts, hedge funds, generally their largest investment, given the size of Naspers and it being almost a 2.5 trillion rand company, has really kept the South African market alive. That together with many of the mining stocks where we have scarce resources like platinum and palladium and rhodium. So companies like Impala and Northam and Amplats and the mining houses that are listed here, Anglo American, BHP Billiton. I think those together with technology have really kept us afloat as an investment destination. The balance of the market is somewhat very different. So, South African banks, South African retailers, which are bricks and mortar type retailers, property companies, and I don't want to steal Stephen's thunder, but they've been under tremendous pressure, industrial companies in South Africa. So the second part, I would say, would all be opportunities to potentially short. And if there were any long opportunities in that, there would be companies, for example, that could consolidate some of their industries and maybe take out some of the weaker players. And I think in property and in retail, we're starting to see that. But on the stronger company side, really, it's really about the mining companies, our view, the rand hedges, and still the biggest, strongest company in South Africa being Naspers.
Great. So how
may I interject with two very quick questions? Sai, give us 2 shares you absolutely love besides for Naspers and 2 shares you absolutely hate.
Okay, so besides Naspers, which is my favorite, and it goes back to me meeting with Chris Becker in the early 2000s every 6 months and coming back to the office. And I remember telling Steve, my partner, never been impressed by a more humble, honest, gracious man. And I've never met another CEO like that in this country. So no disrespect to anybody else, but he was an absolute true legend. Besides that, if I looked at companies I'd like to invest in now that are in South Africa, I can't find many on a longer term perspective. In the short to medium term, I like the likes of Northam and Impala because China has re-accelerated its growth path. It seems to have gone through the virus rather quickly. It's back producing vehicles at a rate greater than last year, so it needs palladium, platinum, rhodium. So I think our mining companies will do extremely well, at least in the short to medium term. So I would say those are good companies. But if you really want good companies today, you have to look, unfortunately, to the US or China, to companies that are at the forefront of technology. And in our hedge funds and many of our offshore funds, we do have investments in the likes of Google, Amazon, Microsoft, etc. So, I'd point you in those directions. In the bad side, I'm not sure if I'm still on the screen because I'm just seeing Dina now, but on the bad side...
You're there.
Okay, on the bad side, I would say, unfortunately, there are a lot of companies in South Africa that are in deep trouble. Too much gearing, not enough consumer power, and in tough industries. So I would look at the retailers. I mean, Walmart's great in America, but Massmart in South Africa looks in dreadful trouble. North of 8 billion in debt. Everybody's starting to shop on Take-A-Lot. A really difficult environment. And there are businesses like that, many of them, in many sectors in South Africa that are too highly geared. And unfortunately, there's no growth here. So I could name many on the negative side. It's much harder to find strong companies to invest in SA.
So, Sai, last question from me. If you were to give advice to someone who had some money, how much of their portfolio should they be in cash? How much should they be in hedge fund? How much in equities? How much in bonds?
Okay, so first of all, you should never be in cash. I mean, giving yourself a current 4 to 5% gross return before tax is really not on. I mean, our hedge fund, as I mentioned, has done 16% per annum over 15 years. So obviously, I would say rather choose that over an equity strategy that's given you maybe 8%. I think you'll hear from Chris just now that bonds in South Africa actually do offer a reasonably good opportunity because we have real rates in South Africa. So at least there may be South African government risk, but in the short term, you're getting, say, 9.5% on government bonds, and that's reasonably much better than obviously interest on cash, which I would definitely avoid. But obviously, I think for all South Africans who want to invest in the market, you know, you need to use whatever allocation you have as well to invest offshore. Offshore equities over time have delivered a far better return than the JSE. From 2007 to now, which is 13 odd years, the JSE is up 3% in US dollars. And if you strip NASPAS out of that, it would be negative. So all I would say to you, you need the right manager to manage your money. If you're going to be invested in the market, it's got to be in the right opportunities. I would have a big proportion of my funds offshore in good managers there, which is often very hard to find. We do also offer those offshore funds. And I wouldn't have any cash, and maybe a selection of SA bonds for the short term. The big risk there is obviously some kind of default by the SA government.
Si, we're going to come back to you towards the end. Thank you so much for that. And thank you to 361 for sponsoring part of tonight's panel as well. So we're actually going to look at some slides and a quick insert from you guys, and we'll be back to chat to you towards the end of the show.
Thank you. All the best.
361 Asset Management is an asset management company with a 15-year track record of exceptional performance. The company was founded in 2004 by Cy Jacobs and Stephen Lipps, and it has in excess of 20 billion rand in assets under management. They manage unit trusts, hedge funds, and segregated mandates. Their clients include private clients, financial advisors, and institutions. So why 361, you ask? 1 degree may seem insignificant after 360 degrees, but it's the extra mile they go, the new insights and information, and the efforts they find and make. It's their seemingly small but deliberate and decisive actions which have the greatest impact. It's what separates the good from the great. The single degree that makes all the difference. That's 361 Asset Management.
There we go. Sai, he can be your voiceover.
Absolutely. Thanks, Howie. You sounded great.
Perfect. Thanks so much, Simon. We will be with, as we said, we'll be back with you at the end for more Q&A. And we're going to be bringing up Stephen Herring now, all the way from London. Stephen is the chairman of Harriet REIT and has been in the property industry for many, 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 many years, as you've said. And yeah, it's been a tough time for property, Stephen.
I think in South Africa around the end of March, someone flipped a switch. And I don't think many companies expected their top line to be hit to the extent that rental income has been hit. And that's created unique times for everyone in the property sector. And as Warren Buffett says, you know, the tide has gone out, and now you can see who's not wearing a costume.
Well, hopefully they'll keep that on, not at the beach. But I know, speaking of that, so in terms of the property, so you're involved obviously in the property market within South Africa, and you also know and very much aware of Australia, of Africa, Australia. Are you seeing the same trends happening in all of those property markets on account of COVID?
Yeah, look, COVID is it's a global pandemic, and it's affected markets around the world. I think the timing of the markets are different. I think, you know, for example, the UK probably had its peak 2 to 3 months ago, and its numbers were really bad. But of late, the numbers are very, very low. And whereas, you know, South Africa's, depending on the city, is peaking maybe, or just entering into the peak period. So we can learn from the other countries about how quickly things take to get back to normal. But I don't think anyone's been immune. The whole world has been affected.
Yeah, and in terms of REITs right now, at the kind of low levels that they're at, would you suggest that investors start getting into REITs at the moment, or do you feel that they're still very risky in terms of where we're going?
You know, the benefits of the REITs for shareholders is to receive, you know, dividends every 6 months. And a lot of investors buy into REITs for the long-term annuity income, and hopefully as well some capital growth. In the short term, there's no doubt that rental income has been hit, some more than others, and dividends will not be, you know, be paid out as normal across the board. Some guys might pay dividends, some guys might pay less than what they paid last year, but the growth rates that we saw in the last few years are not going to be there. So there's going to be short-term pain, but at the same time, you know, the share prices are particularly low. You know, in my 20 plus years, I would say to you that some of the REITs hit levels March, April, May that were cheaper than when they listed 20 years ago. So I think people got really scared, and I think the pendulum has swung too far in one direction. So if you're looking at the short term, I'd say to you, be cautious. But if you're looking to buy and you've got patience and you're prepared to wait 12 to 18 months, there's no doubt the levels are very, very cheap at the moment.
And in terms of looking at diversification, so international REITs or looking at the South African market, again, you're involved in both. What would be your advice?
So the South African market, I think you need to be very careful and look at the individual stocks. I think gearing plays a huge role at the moment. You're seeing companies where the leverage is too high, taking a lot of pain. Their funders are becoming concerned. I mean, to share with you the numbers, South African REITs are generally geared between 30 and 40%. But there's some counters that are pushing 50 and 60%, and that's just not on. So those counters that are highly leveraged, you know, are either going to have to cut their dividends and reduce their debt. They're either going to have to do a capital raise, or they're going to have to start selling assets. So, you know, certainly look in South Africa for those counters where the gearing is conservative. And then also look for counters where there's an alignment of management. You know, today we see two camps. We see shareholders and we see management. They need to work together, and there needs to be an alignment. So if you can get counters where the directors have a serious stake in the business, that always goes a long way. You know, those are the guys that are getting up at 4 or 5 in the morning and thinking about things and living their business. And that's what needs to, and those counters generally outperform your sort of day-to-day average managers. So, you know, you've got to also look at, you know, sustainable cash flow, because you're buying into these counters to create that annuity income. So, you know, look at the cash flow, look at the gearing, look at the quality of the management. But I really think, you know, South Africa has some really good opportunities. But I wouldn't, you know, you've got to know your stocks, and you've got to do your homework. But there's no better time if you buy right. In the medium to long term, you'll be smiling. When dividends are back, you'll have capital growth, and that's what investors want. And I think the same applies internationally. You know, you can't just say, well, I've got a foreign allowance, and you go and invest offshore. What are you investing in? Do you know these counters? Do you know the management? Do you know what the assets are behind them? So you know, as shareholders, we also just trust people that they'll go out and allocate funds for us. And, you know, the shareholders need to be involved. They need to know what they're doing. And otherwise, you know, just letting third parties make blanket decisions without understanding what they're doing, I don't think is right. So by all means, use the professionals, but understand as well what the strategy is behind the growth. So, you know, the REITs have been hit all over the world. The UK, US, you know, as big as these markets are and as good as they are, they've all been hit. But within that, that's where the opportunities are right now.
Yeah, and also if you look, as we said, like now, obviously looked at COVID and the effect it's had on the retail environment. We've seen Into literally be put into liquidation in the UK with the bigger shopping centres, the legacy of Donald Gordon, something that I don't think anyone thought they would see, especially the amount of people that they employ, and also offices, people working from home now. Do you think that this is going to have a fundamental effect on those sectors? And what do you see as the future of those from a retail and office space?
So Intu's gone into administration. Their gearing is about 68%. But again, there hasn't been the alignment of management with shareholders. So I would like to believe if the late Donnie Gordon was alive, he would have foreseen what was coming. He built the company. He would have made strategic changes. I mean, along the way, they got some serious offers. I think Hammerson offered them over £3 billion at one point. They got an offer as well of 4 or 5 billion at one point. They never accepted it, So you've got to have that alignment of interests. And I think as well, their capital structure was poorly set up. They went to their creditors, their bankers, their bondholders, and they asked for a deferral of repayment of capital. And they had to get everyone to agree. One party out of Canada, the Canada Pension Fund, decided they're not agreeing, and they had the bond over the Trafford Centre in Manchester. So because of a poor capital structure, they're now gone into administration. So who's the leader there? Who's taking charge and who's sorting it out? And we've seen valuations down, but that management could have kicked in and maybe paid the 250 million to the Canada Pension Fund, or raised it somewhere else, or sold that one asset, and maybe they wouldn't be in the position they are in today. So I think around the world, people underestimate. They just read the balance sheet and they think, well, company A is equal to company B. But there's so much more behind the team and understanding that team and their expertise, and that's what you really got to look for. But again, what will happen with Into, time will tell. That story is not over. They're not in liquidation yet, and I'm pretty sure that John Whittaker or some other big group is going to come in and do something interesting there.
Steve, I want to ask about the Johannesburg and Cape Town property markets, because I think we've seen in Sandton, even before COVID, in excess of 400,000 square meters vacant in Sandton. That was before COVID actually began. Yes. Now many businesses are looking to downsize, and I think we have the exact same problem in the center of Johannesburg, or at least the center of Sandton, center of Cape Town, maybe even parts of Durban and Umhlanga as well, that we have this huge oversupply of offices, that companies have gone and built massive monuments to themselves, but their old buildings have all been left vacant. So the real unterste Schurer question is there hope for the South African commercial property market, office-wise, within those centers at the moment, or over the next 5 years?
Sam Zell speaks about supply and demand, and it's a simple thing to work out. You've got excess supply in the market, you've got no growth in the economy. So who's going to take up that space? So it's really about repositioning those B and C grade buildings into alternative uses. You had it in Joburg CBD, where 20 years ago, Dina did a thesis on it, but 20 years ago, everyone was leaving the CBD and moving into the suburbs. So you had all these vacant office buildings. Now you had guys like Alec Wapnick that walked in there and were picking up the buildings for nothing and converting them into residential towers. And people thought he was crazy. But there was huge demand, and he was one of the few who was doing it at the time. Now the supply and demand is caught up in the Joburg CBD, but the same has to apply in Sandton. There is no net growth. So who's going to take up the space? So there has to be these conversions, or there has to be a big drop in rents to get guys to move into Sandton from other areas. But either way, the landlords are going to have to decide, redevelop or adjust your rental levels. But you can't continue with these excess vacancy percentages. They're just far too high.
So Steve, last question from me. If you were a new investor, coming in and you needed to split your assets between different asset classes, what percentage today in South Africa would you put into the property sector, excluding your own home?
Look, I love the real estate market because it grows and it compounds over time, and that's an industry I understand. So I would put a high percent of my wealth into that sector. But at the same time, I think you need to differentiate between private real estate deals and the JSE. I think today a lot of properties are being sold at 100 cents in the rand, and especially in this market, I'm looking at it and saying, well, why pay 100 cents in the rand and go and buy a property? It makes no sense. You can go and buy a listed REIT, which has a portfolio of assets, which might be diversified internationally, that might have strong management. And if you work it out, some of them are trading at 50 or 60 cents in the rand. So for me right now, I just see it as go into the listed space where there's just so much more value.
Cool. Thanks, Steve. Nice input.
Thank you, Steve. So we heard that apparently there's a good management team at Harriet.
I've heard that as well.
Rumor has it.
Yeah.
Thank you so much. But we'll definitely be back with more questions. I can see that coming in at the end. And now, Howard, I believe we are going to a commercial break with Mantis.
Well, Mantis have in fact been the sponsor of so many of our webinars. So a huge thank you to Mantis, and fantastic once again. I think when we see their video now, you'll realize just how many properties in South Africa Mantis in fact looked after them. Dina, there's financial security and there's real security, and nice to see that Mantis has in fact meshed both of those together.
Absolutely, and we thank them so much. They've been so consistent on all of our webinars, and we can't thank them enough. So absolutely, physical security is key. And with that physical security, we bring in Peter Armitage from Anchor Capital. Good evening. How are you, Peter?
Hello, Dina. How are you?
Fantastic, fantastic. I'm sure you're listening to all of this and your head's spinning, because I know you've been in this industry for like over 25 years. You're involved with it on a daily basis, locally, offshore. What do you think in terms of property, South African property, if you're invested here at the moment?
Yeah, so I think, as Steve says, you've got to differentiate between listed and physical property. I think physical property valuations are down a bit, but the real bargains are to be found in the listed space, but you might have to have some patience. Yeah.
All right, so do you think at the moment that we're playing a long game?
So I think, people, when things are really undervalued, people always take a view that, it'll take 18 months for things to recover. I think once you see some positive directional movement, things can move very quickly. Take a Redefine, which got from sort of 11, 12 Rand down to the 3 Rand. If things recover and things turn out all right, it's never going to get back to 11 Rand in 5 years. But if you took a positive and a base, like a positive scenario, you can get a 50 or 100% return quite quickly.
So do you have any favorites in that sector at the moment?
So we, I guess it depends what kind of risk profile you want to take. So we'd stick with the big ones. A lot of the smaller ones have got too much debt and are quite troubled. But it's, the safe one is Growth Point. It's gearing is in a good place. But it's, it's come from 22 to 14. It could probably go back to 18. If you're willing to take a bit more risk, you go with something like a Redefine that's gone from 11 to 3. It could get back to 5 or 6, which is obviously big in percentage terms.
Right. And in terms of what's going on, so the whole markets, obviously have been in absolute turmoil, but we've seen massive gains overseas as well.
Yeah.
So what explains all of this? Because it doesn't really seem to make sense.
I've got a few slides. Shall I put them up, which kind of address these issues?
Absolutely.
Would you prefer just to chat?
All right. Yes, the fact that you've taken the time to do these is very good for those who are watching.
I'll just say anybody who wants to see them can obviously have them. There's a lot of info in these things, as there tends to be. But I think, and I can possibly just move through with the things that answer your questions. But I think if you look at markets, if we go to, so this is quite a nice graph to answer your question, the S&P, the US stock market. So we started the year with the S&P at about 3,200. At that stage, we thought it was fairly expensive. It went up about another 5 or 6%, and then went down 30%. And if you look at where we are today in July, you're basically back to the values of June. So the market is certainly priced in a lot of optimism. A big driver has been the kind of free money that the Fed's throwing in the US. I think something that really struck me the other day is Amazon issued a 3-year bond at 0.4%. So they're getting money virtually for free. And if they can invest that at a reasonable return, it's hugely accretive for the business. But I think so we think markets are pretty expensive, Dina, but I think another very important thing to understand is, we all look at indexes and what the market's done, but within that, and the chart you've got on the screen here, is if you look at the US market, which is now basically flat for the year, but a huge divergence between different companies. So technology and communications, which is kind of your tech sector, up about 15 to 20%. And within that, some companies up 50, 60, 100, 150%. And at the bottom, the energy sector is kind of almost, that's at double issues in terms of oversupply and fights between Russia and OPEC not all coming together, but obviously energy usage down. But your typical industrial financial business in America is still down about 15%. So what's happened is in the technology space, and we will all have experienced it. In fact, I want to show you a graph here, which is quite amusing. A picture here. So Zoom that we're working on today, in December last year, had 10 million users a day. And they're now up to 300 million users. And the value of Zoom is now $73 billion. So that's well over R1 trillion, which is almost double the top 7 airlines in the world. So there's been a complete change in what's happening out there in the world and the value of different businesses, and people are seeing the future of businesses very differently.
Absolutely. But do you think this is sustainable? So obviously, yes, the world's been the countries that have been in lockdown, and people have had no choice but to use the technology to get online and to actually go work. But we've also got the likes, obviously everything's up from Amazon to Microsoft, Netflix. Do you think that these are sustainable numbers, or do you think that we're going to see another correction?
Yes, I think what you've seen is the trends that were always there in the world. And I'll come to a chart over here. So this is e-commerce penetration in the States, a percentage of retail sales. And if you look, the trend just gradually increased. And certainly you will all have seen by your own experience that suddenly people have become more familiar with online shopping. I think people who would never have done it or would only have done it in 5 years' time are now experiencing it. So you had that kind of 1 or 2% increase every year. And in an 8-week period this year, you've seen an increase from 16 to 27% of all retail sales are happening online. A lot of that because people are forced to do. And I think the Microsoft CEO put it quite nicely when he said the global trends that are happening have simply been accelerated by 2 years. So, 2 years of growth has been squeezed into a few weeks. So a lot of it is trends that were always in place, and a lot of companies are benefiting from it. And I think as when you can earn virtually nothing on your money sitting in offshore markets, and in fact, if you're in Europe and you put your money in the bank, it's going to go backwards if you leave it there. People are forced to go and to get any kind of return. They have to take a bit of risk. So they want to get into equity markets. And there's a lot of businesses, so the US market's been split, as I showed, between businesses that have benefited and businesses that have suffered. And the businesses that have benefited have been revalued by 20, 30, 40% on average.
And how do you explain it, like, for example, a complete outlier, which also does sort of sit in that technology space, but like Tesla? I mean, that share is now about $1,500, which is a crazy sort of growth amount for that company.
Yeah, no, there certainly are some crazy stories. I mean, we don't personally like Tesla. We love the product at a lower valuation. We're very happy to own it. You've always got to differentiate between whether you like the business and like the share price. And it's always tempting to talk the company down when the share price is high. But ultimately, it's an automotive manufacturer. These companies tend to trade at 8 to 10 P multiples. And you're now paying in market cap. Saw an interesting chart the other day, about $700,000 per car produced. So you're paying more in value than it would cost for the share. And obviously, the profit made off that is very small. So I think, there certainly are shares that have really kind of gone through the, become overvalued and overhyped.
So in terms of, sorry, just last question. In terms of your view, from an if you're in South Africa and you've got rands to invest, what should you be looking at from an investment point of view? Should you be looking at offshore equity? Should you be looking at bonds? You clearly agree with Sai in terms of saying that cash is really going backwards or you're not making any money on it. What would be your advice?
Yeah, so, I mean, we put the slide together to really summarize the view, Dina. So, I mean, we think South Africa is less than 1% of the world. The only people who have more than 1% of their money in South Africa typically are South Africans. In South Africa, you're really limited to kind of 50 or 60 shares. The globe offers you the opportunity to invest in different investment themes and in different businesses. So, we think you should become a global investment citizen. I think the slide that I put up for our business, if you look at the bottom there, we're now describing our business in dollar terms. We're saying we've got $3.8 billion of assets. It's quite sad because it looks much better when you say 65 billion rand. But we think it's time to be patient. The markets have run quite hard. As we showed you, they're quite expensive and they're factoring in a full recovery. So we don't like being in cash, but we'd be happy to wait a little bit. I think the equity markets, especially if we find a vaccine, all the fear goes out of the markets. You can see a recovery from the kind of shares that still haven't recovered, as we showed you. We'd still be in the tech shares for the longer term, but you obviously have to be selective and avoid things like Tesla that we think are overpriced. We like local bonds. I think I've tried not to touch too much on territories that other guys are going to talk about. Let Chris talk about that. You can get a 9.5% yield on those. I think mirroring what Sai said, the buy and hold equity model in South Africa is broken. You need to be in something more active. You need to be in a hedge fund. You need to be in a structured product, specific products. Gold, we think, is a place. I think the key message is really to be diversified. It's a very, very risky time and an uncertain time. We can't tell you with any certainty where things are heading. So I think you want to kind of be across markets. And then, of course, for South African investors, a key headache is the rand. So this is our purchasing power parity and kind of fair value model for the currency. And you can see the times when it's really spiked, going back into the internet crisis, the 2008 crash, Nene being fired. And this is, in fact, the biggest move we've had in the currency away from fair value. So the dotted line is the theoretical market fair value, which would have the currency going back to 14 Rand over the next 12 months. We don't think that's likely to happen, but there's certainly quite a strong argument for the currency to strengthen a fair bit more from this level.
So Peter, if people are going to diversify offshore, at what level of Rand do you think is a good time to push that button?
So I think an important point is this isn't black or white. So it's not a case of take all your money at a point in time. I'd be, it depends what you've got offshore. If you don't have any money offshore, I'd start to do it right now. If you've got a fair proportion, as most high net worths do, I think once you got below 1650, we take a little bit, take a little bit more below 16. At kind of 1550, I'd be happy to take my full allocation.
So, two difficult questions. The one is Alan Denby was going to come on. It looks like he's having some internet issues.
Is he not coming? Okay, I didn't cover gold because I knew he was coming on.
So touch on gold at this point in time, because traditionally gold has always been a safe haven during periods of crisis, but we haven't seen massive shifts in the gold price during the COVID crisis at all. What's your view on gold?
Well, you've had some quite big moves. Gold is sitting at quite an attractive price. I think number one is to take the rand into account, and whether you're investing as a dollar investor in gold or whether you're investing in as a rand investor in gold. I think so. We're putting a few percent, about 5% of our offshore portfolios into gold as kind of protection. It obviously doesn't have a yield. It benefits from the fact that yields around the world are low, so the cost of holding it is quite low. But our kind of central view is the world recovers, especially if there's a vaccine, and if the world goes risk on again, then gold as a protection falls away a little bit. So we think gold makes sense. We're not great gold bulls over time, but it's certainly, from a kind of sleep peacefully at night, knowing that your portfolio is hedged, it does make quite a bit of sense.
So last question, give us practically 5 shares, local or international, that you would like to put some money into.
I think I just want to go to, the thing that's done best in our universe is, our Anchor Global Equity Fund, which has done about 30% in dollars year to date. That's kind of the return over time. We've done about 40% over the last year, which I think puts it in kind of the top 10 funds in the world. We've taken a very big view and bias towards the global technology sector. And there have been shares here that are up over 100% year to date, which have benefited from the kind of trends that I'm talking about. We obviously wouldn't be, so this is our kind of top 10 at the moment in the global space in the equity world. So you can see Amazon, Alibaba, Netflix. Our fund manager loves it. I think it's become a bit too expensive. So if I was to choose one out of that list, I'd probably go with an Alibaba. And then lower down, Spotify, we think has got the potential to kind of own the music space, and has still got quite a bit more upside potential. In South Africa, if you've got, I'll stop sharing the slides now. I think we've gone through kind of most of them. From a domestic perspective, if you've got money that wants to be invested in local equities, we think a very interesting share is Sibanye. We like Sibanye, but MTN is the one I wanted to talk about. MTN's got it's not a great business, but it's got an underlying fair value, we think, of 70 to 100 Rand. It's trading between 50 and 60. All other telecoms companies around the world have done very well because obviously, it's kind of suited to COVID and has benefited from it. And because of its Nigerian exposure and the oil market, it's come off 50, 60% in this crisis. So that's one you can trade around. Naspers, again, it's become so big in our markets, but I think to keep on remembering Tencent, which is its key asset, it's trading at half of the value of Tencent. So somehow, somewhere, they have to do something to kind of benefit from that. So those would be the kind of shares that we're looking at.
A question that's come in from one of our viewers is Jack Ma recently sold about $10 billion worth of shares in Alibaba. Should there be any concern about that?
Yeah, so I think to put that in context, he's still got about $80 billion of shares in Alibaba. So, for us, unless you really smell something in the company, the kind of stuff that Sa was talking about, if management remains heavily incentivized to make it work, remembering he's already stood down as the CEO, there's other management running with it. We don't like seeing management sell shares in company, but if I had $100 billion in one company, no matter what it was, I'd probably want to diversify 50% of that out. So that by itself doesn't scare the hell out of me. But one of the key reasons is Alibaba's showing great fundamentals and great growth rates, but has lagged the huge performance of the other tech shares around the world. So it's it's only up about 20% for the year. I say only, but we think it's got quite a bit more upside and some catch up to play. So we like this space, and it's the one that's kind of lagged, and its fundamentals certainly aren't lagging.
Peter,
Great.
thank you so much. We'll see you a little later on. A few people have posted in the chat they'd love to see your slides. So if you can give a copy through to Dan Stillerman, he'll mail them out when he mails out the links to everything that we've seen this evening. But we'll see you a little later on in the Zoom broadcast.
Fantastic.
Thank you. All right, and Howard, I believe now would also like to go to one of our sponsors, which is Switch Smart. So I think we have an AV that we'd like to show.
Dina, I hope you have some of those, because I think it may be impossible to live without some of those SwitchMart switches that turn on your house, open up your blinds, warm up your bed before you go, then turn on the DSTV and record your favorite programs.
Listen, I have to tell you that we do have Alexa. So my children now want every component that can possibly connect to it. I have got a full list on the Amazon in the cart waiting to come.
When I ask Alexa questions, she says, "Why don't you listen to me? I told you that already."
Well, she's a clever girl. Talking about clever, we have our next panelist on, Chris Holdsworth. Chris, you are the head of investment strategy at Investec Wealth and Investments. Welcome to the panel.
Thanks, Tina, and hi to everybody.
Everyone is telling us that we need to talk to you about bonds. Every single person has mentioned, every single panelist has told us that you should particularly talk to bonds. Is that something that you think we should be investing in at the moment?
Very happy to chat about SA bonds or global bonds, as the case may be. I also got a few slides which I've sent through. You can whip those up as well to talk about it. Another theme that's come out of our investment process as well. But firstly, just touching on bonds in SA. At the time of the downgrade, our bonds blew out. They've subsequently recovered somewhat, but they are still extraordinarily high relative to other countries around the world. If you compare us to other countries that are similarly rated, like Brazil, for instance, our yields are higher, whether you measure it in dollars or if you measure it in local currency. Brazil, in fact, is rated worse than us, and it costs less for the Brazilian government to borrow in dollars than it does for South Africa. So there does appear to be a fair degree of pessimism priced into SA bonds, given the fiscal position that the state finds itself in. And perhaps that's understandable. But if one applies some degree of second order thinking, if the government does land up in fiscal difficulties, they will do their best to resolve that in one way or another. And that's either through increasing taxes or through asking pension funds to support them, which they're doing now through investments in infrastructure, which would be taking money from elsewhere. So if one has an allocation to South Africa, on the one case, you've got bonds yielding 9 and a bit %, while inflation today has just come out at just over 2%, with the prospect of the government at some point leaning on SA consumers or pension funds and forcing them to sell equities and buy bonds. For us, the fiscal risk implies a preference for bonds over equities. So we do like bonds in South Africa, especially relative to SA equities in the current environment that we face.
And you're obviously responsible for looking at the South African strategy from an equity point of view, but you do sit on a global committee as well. And are you seeing differences in those different strategies that are coming out right now?
Yeah, and that's actually the theme that I wanted to talk to for this presentation. And so it's first key to note that these aren't necessarily my views. I sit on a global investment strategy group. It's an investment group populated by investment professionals in London, Switzerland, and South Africa. It's a group of CIOs, heads of research, and a few other people that have seen a few cycles. And we come up in aggregate with a view on global risk. Should be risk on or should be risk off? And that view feeds through to the asset allocation committees, and we translate that into some form of investment theme. And that's what I want to try and show. So I'm going to try share.
If we can try and bring that up. So I was just getting a question here. Is there a case to be made for the carry trade to improve the Rand exchange rate and bond rates?
So we are actually going to be talking on that. So let me see if I can get this.
Like I'm asking all the right questions.
There we go, macro highlights. So, okay, so what I'm going to do is run through 8 slides. So this is the way I want to allocate my 8 to 10 minutes, just having a look at some of the inputs and outputs of that investment process that I spoke to. And it's going to speak to what I think is, or what we think is the key investment theme one has to get a handle on. And that is the strength of the dollar, or to answer the question, the view on the currency, on the Rand. Now, a lot of the moves in the Rand are not due to what's happening in South Africa. They're simply a function of what's happening in emerging markets in general and what's happening to the dollar. So in many cases, when the Rand is weakening, it's really just the dollar that's strengthening and vice versa. So what we're going to do here is frame our view for the dollar. Now, the first thing to look at is this chart over here. And what this shows is a summary of data that comes from Google. They track all of us through our cell phones. They know how much time we spend in retailers, how much time we spend at home, how much time we spend in transit. And we take an average of all 3 of those across all countries around the world, except for China. They don't allow this data to be made available. And what you can do, once you plot that, is you can see that global activity bottomed in April and has subsequently been recovering at varying paces. It's faster for developed markets than emerging markets. But the point is, globally, activity due to lockdowns and the virus bottomed in April and has subsequently partly recovered, and it's on the way to getting back to normal. While that's happening, the dollar is pretty much as strong as it's been in 20 years. A month or so ago, it was stronger, but aside from that, it's as strong as it's been. Now, this chart shows what's known as the real effective trade-weighted dollar. So it is the dollar trade-weighted against all trading partners, so against the euro, the renminbi, the rand, and then you strip out inflation differences, because countries which have higher inflation should see currency depreciation, like South Africa, for instance.
All right, and what is the reason behind this? Why is the dollar performing so strongly?
So for 2 reasons. The first is the US economy, up until now, over the past few months, has been surprising by far more than any other economy. The data that's been coming out has been very good. In terms of retail sales, they picked up strongly. The bounce, the V shape, was far more steep than was widely expected. That's the first story. The second is that at the height of the crisis, there was increased demand for dollars. It is the safe haven currency. And when times are uncertain, people want dollars. They will sell everything else just to hold dollar cash. So that's the story that's been happening the last 3 months, but that's starting to change. If we look at this Google tracking data again, and we look at the US relative to other developed markets, the effect of the second wave of infections is already starting to come through. While other developed markets continue to grind higher, we're already seeing activity rolling over in the US simply by measuring how much time people are spending outside of their homes. But that's an eccentric measure. We wouldn't want to place too much faith in that. So we can look at other high-frequency measures of activity. And what I've shown here is 2 examples, and I'll just run through them because we don't need to get into technical detail. But the one on the left is year-on-year changes in gasoline sales. Now, we get this data on a weekly basis, and we can see that it bottomed in April, subsequently has been recovering, and now is rolling over. the chart on the right is how much money people spend using their Chase credit cards. It bottomed in April, subsequently improving, now rolling over. And we can see it as well if you look at the number of people passing through TSA security. It bottomed in April, has been improving, now rolling over. The number of people actually attending restaurants, bottomed in April, picked up, now rolling over. So there's a lot of data suggesting that the US economy is starting to roll over as the rest of the world continues to recover. So that first argument for dollar strength starts to be removed. It's not the case anymore that the US economy is surprising by more than the rest of the world.
Okay, and are we finding the Trump election and the upcoming election in November that has any effect on this?
It does in two ways that are difficult to capture in currency markets. The first is what we've seen is the probability of Trump winning the next election has declined materially over the past month or so as the second wave has become evident. And the best way to measure that is through the betting market. If you look at the odds of Biden coming through, the betting market is pricing that at about 65% chance now, with Trump at about 35%, give or take a couple of percent.
Have you got Kanye West in there?
He is now sitting at zero. Kanye, believe it. No, so he is now withdrawn. So that has implications, though, because Biden is running on a campaign to raise company tax. And this is another reason for concern with US equities. His policy proposal is to raise tax in the US from 21 to 28%. And the question was posed to him, would you still do that in the beginning of next year, even if the US economy is in doubt and is weak? And he said, no, you wouldn't do it then, but you do it later. So he does want to push up company tax in the US, and that would have an impact of roughly 12% on S&P earnings. Now, whether it happens this year or the year after, if it comes through, there is a concern about earnings from the US, particularly relative to the rest of the world. Now, that hasn't fully been reflected in US equity markets yet, because on the other side, the lower the probability of Trump coming through, the more urgency there is for a stimulus package, which would be very positive for equities. So there's a likelihood of a stimulus package coming through now, but subsequent to that, in the years down the line, we'll end up with a higher tax rate, which means greater risk for US equities 12 months down the line, but perhaps some support over the short term. But just one last point on the dollar. So the first reason was the US economy was surprising. That is no longer the case. The second is that there was this massive demand for dollars during a crisis. And to meet that demand, the Fed opened up emergency funding lines to central banks around the world, and they were allowed to lend out dollars to their banks. Well, this chart from the FT shows that those banks actually don't want those dollars. They're shutting down that funding line. So there's less emergency need for dollars too. So now you sit in a position where dollar supply in the US has gone up, money supply is up 25% year on year, a lot more dollars, while there's less demand for dollars. And the US economy isn't surprising as much. So if we put that together, the view that we come to is that the dollar is likely to weaken, especially considering that it's as strong as it's been in 20 years. Which, and this is the conclusion from these slides, I'm happy to answer any questions on either SA asset allocation or global after that. This chart shows the dollar, which is that blue line, which I showed before, very strong. And the red line is the performance of US equities relative to the rest of the world. Now, over the past decade, US equities have absolutely smashed the rest of the world. And partly that's due to sectoral reasons like IT doing well, but partly it's due to the dollar. When the dollar strengthens, US equities outperform the rest of the world. If we're expecting the dollar to weaken, that implies we're expecting rest of world equities to outperform the US. Now, it's a big change. It'll be the first time in a decade that actually happens, but that is something that we seriously are considering as likely, and is something that is running through our investment process. That doesn't mean we don't have anything in the US. It just means we're increasingly looking outside of the US, in emerging markets and in Europe. And that comes through from the high frequency data that we're seeing, and it ties into an investment view for the next 12 to 18 months. So Dino, that's what the bit that I wanted to get through. Happy to answer any questions on either that or SA.
Okay, great. So I think we should park the questions for our Q&A afterwards, but it is very insightful in terms of the US dollar and also looking at alternative markets, which I think we can hopefully get into in the Q&A instead of US markets. So where can we find value? Howard, I don't know if you've got anything to add.
Well, I just want to say, if Chris, for example, had R1 million to invest from scratch, where would you put it now, Chris?
Yeah, that's a great question, because it dodges some of the compliance risks associated with that typical type of question. Look, I think the opportunities in South Africa lie with yield rather than growth. So if one wants to construct a balanced portfolio in the typical way, your South African bonds offer an attractive yield, a significant real yield above inflation. So your fixed income allocation you would do in South Africa. Your growth allocation would be outside of South Africa. Outside of SA, you've got over 10,000 shares that are listed. In South Africa, you've got about 100 that are liquid. And then within that, you would do sector themes. We would play global resources. That is our big theme. So a combination, which we would do a balanced portfolio, but within equities, an overweight for resources in particular to capture the cyclical upswing that we think is coming about from a recovery.
So Chris, just to be very specific, your money, which bonds would you put your money into when you talk about bonds?
Yeah, okay. So in South Africa, there's a couple of ways to do it. So if you were to invest at the short end of the yield curve, for instance, and in cash, you would get very little. We do think that there is a risk down the line of inflation in SA. So the way that we do it within our pension fund portfolios and with our balanced portfolios is that we roughly evenly split now between inflation linkers maturing in about 10 years and nominal bonds maturing also in about 10 years. And that way we hedge ourselves against the possibility of higher global inflation because of the increased money supply out of the US. And at the same time, through the nominal bonds, we're able to capture this extraordinarily strong or high level of yields in South Africa. So to answer your question succinctly, roughly 10 years inflation linkers and nominal bonds.
And if I call up my bank at Investec and say, I want what Chris is offering, they'll be able to do that?
Through a balanced portfolio, yes. Buying individual bonds is a bit more tricky.
Okay, cool. Thanks so much, Chris. We'll see you a little later on in this broadcast. Thank you so much.
Sure.
Dina, how on earth did you in fact twist your husband's arm to sponsor yet another one of our broadcasts?
Howie, he believes in our broadcasts, he believes in our webinars, he thinks the content is phenomenal and can't wait to sponsor.
But not only that, he's done an amazing thing with his business, with one of his buildings as well. So he has this huge signboard on his Grayston Drive that he in fact offered to SMEs who are struggling during this period. He actually offered free advertising space on his billboard. It's just the nicest, biggest menschlich thing that anyone could ever do.
Listen, absolutely. And also having that sort of access to those kind of funds and those kind of sort of commercial budgets generally that are literally reserved for big companies is very hard for small businesses, and especially in times like this. So he thought it would be a nice offer to offer SMEs a free advertising space, as well as different charities like the Gev as well that have used that sign. So it's a great thing.
You married a good man. Let's hear from, in fact, his business, North Face Capital.
Looking for office space, industrial space, showroom or restaurant space for your business? North Face Capital develops and builds the right property solution for your business. Top of the line, flexible, customized modern solutions that contribute to higher employee productivity and customer satisfaction. Go to northfacecapital.co.za or call 087 7500 to find flexible, productive, quality space for your business. North Face Capital, developing for today, growing together for tomorrow.
A huge thank you to Andrew Diamond for the amazing sponsorship, and we certainly know that the people watching this looking for property will come first to North Face Capital to look for their requirements.
Hopefully. And yes, and with that, we go global and we're going back to the UK. We are going to Jared Khan from Credo. Good evening. How are you?
Well, Dina, how are you doing?
Good, good. Are you still getting comments and messages from all your friends across the world?
No, that's stopped now. I think they're all listening intently to all the good content that's going on at the moment.
Well, hopefully you can give them some good advice as well. So I know you've been obviously listening to all these conversations and you've been sort of very much aware yourself of everything that's going on globally. And you've also, how long have you been living in the UK for?
So I've been in the UK just going on 19 years. I think end of October will be 19 years.
Wow. So it's quite a while, but obviously I would assume that you very much have your finger on the pulse on the South African market as well. So what would you say if you look at sort of diversification out of South Africa and looking at international opportunities? What is your view from a Credo point of view and from your own analysis?
So yeah, for about 20 years now, we've been looking after money from out of South Africa, and it's clear that South Africans are very euphoric in terms of boom and bust. Every time I go visit, which is 4 or 5 times a year, depending where the rand is, depends on the sentiment in the country. And for many years, I kind of got the kickback from clients is, why should I invest in the UK or in Europe or in the US when I can make 15 and 20% returns here and the rand so strong? But I think the point that SAJR made was very pertinent in the sense that in dollar terms, the JSE over the last decade has actually been pathetic. It's been pedestrian. And that's really the message that we give to all our clients. We can't time the strength of the rand. We can't time, the political climate in South Africa. And what we tend to tell our clients is that you should always be divesting out of South Africa and you should be investing offshore. If not only for a rand hedge, but clearly to capture the upside of the best quality companies in the world, i.e., the tech companies in the US or otherwise. And I think that's really the message that we try and give our clients.
Okay, and are you seeing any sort of permanent changes, you think, from this crisis that we've just gone through in any particular industries?
So, that's quite a obtuse question, but I think if I understand the question, I think there are a few long-term structural changes that are occurring in the world right now, and they're short-term. And you've seen the tailwinds for certain industries, tech being one of them, the likes of a Zoom popping up and becoming a world player, Amazon having a fantastic time. And as Peter says, you have what Microsoft have achieved in 2 months would have taken them 2 years. So you've had a transformational move, but we think structurally of certain sectors that are almost uninvestable going into the future, certainly sectors we're staying away from. So one would be something like civil aviation. I think the travel industry, airline industry in particular, Boeing, Airbus, the like, that's going to cyclically take 3 to 4 to maybe 5 years to get back to any kind of level of demand. So we would stay away from something like that. I think the property market in the UK is very interesting, and I was listening to Stephen. I think retail in the UK has been on its knees anyway prior to COVID, and I think this has just pushed it over the edge. We've had Inchu, we talk about Hammerson. I think the UK retail property market is in serious problems. And commercial, also when I talk to my mates, I look at our industry. The work from home environment right now is so comfortable and it's so productive actually, that many companies today are actually starting to initiate some kind of work from home policy. And, just looking at our business, we think that we won't need to upscale for the foreseeable future. We'll have hot desking, we'll have rota systems. And speaking to a few of my mates, it's very much the feeling. So that demand for commercial space going forward will be, there'll be a question mark over it. And then you've got other things like industrial that have actually performed quite well, and then specific areas within the property market like student accommodation, which is quite niche. But I think structurally property will change. And then obviously just the increase of online is just escalating massively. So these are structural changes that we're definitely seeing post-COVID.
Right. So are you adjusting all of your portfolios to align with those?
So yes and no. We intrinsically are value investors, value/quality. We buy stocks on a 3 to 5 year view. We are relatively diversified in our investment approach. Unfortunately, a lot of the technology companies today screen very expensively. So we haven't been able to capture massively the upside in that. But in our fund, the Credo Global Equity Fund, our 2 largest holdings are Facebook, Microsoft, in fact, Alibaba. So we have participated to that point. But we certainly haven't owned the likes of an Amazon and a Tesla, and probably won't. But a lot of our portfolio comes into what I'd call the rotation stocks. The stocks that are cyclical or stocks that have been hurt because of COVID. And we're not changing our investment philosophy just to try and catch the go-go momentum and growth that's happened, particularly over the last 3 months, specifically in technology and growth. So what we have done is been through our portfolios, looked at stocks where we think there's been a credit crunch, where the balance sheets are particularly exposed. Thankfully, there haven't been many companies. And we've also looked longer term structurally, whether we think there will be a bounce irrespective of whether there will be a vaccine or there'll be a V-shaped or a W-shaped or whatever recovery. And that's generally how we manage money. It's long-term, it's quality businesses. And as long in the short term, the credit crunch is gone, as long as these businesses stay on top of their game, which we think they will, we're very comfortable on a buy and hold philosophy.
Okay, so would you say that you've pretty much got more of a sort of less like a little bit of a risk averse strategy?
I don't know what you want to call it. I think there are two things we worry about when we invest is downside capital protection. So buying stocks on 100 times multiple, and when you get a derating in the market and there's no downside protection, that worries us. And hence we try and stay away from higher valued companies. And also, style drift. We are intrinsically value or quality investors, and we're not going to go into that kind of momentum trade. So we are, if you want to call it, a little bit more conservative, and we buy stocks for the longer term.
All right, absolutely. And Chris also talked about looking at more emerging economies and looking outside of sort of your traditional, where the technology sits predominantly in the US. So maybe like the Chinese markets. How are you feeling on those?
So again, our main focus is developed markets. But having said that, we do own Alibaba. It's a big holding in our fund. And we have dipped from time to time into a company like Tencent, but Tencent always tends to screen quite expensively. So we did buy it at the time where there was tension between China and the US. The stock drifted down to $260. That was our entry point, but we subsequently exited that position. The same with Alibaba. I mean, we bought it when there was stress in the stock. So we do like to buy, if you want to call them Chinese or emerging type of companies, but where there's a stressed pricing. But intrinsically, we're not going to buy C-Trip and Baidu and all those kind of Chinese companies. We like to stay in developed markets where there's definitely better corporate governance, transparency, liquidity, and we don't have the fear, that Trump or his or what someone in his regime is going to, cut off listings or things like that. Although having said that, we don't think that's going to happen because there are other avenues. Hong Kong is another avenue. The UK would very happily take Alibaba or Ant Financial or whatever the case may be as a listing. So I don't think that's really an issue, but that's where the opportunities are thrown up in terms of opportunities to buy these stocks slightly cheaper than where they generally trade.
Right. So top 3 stocks to choose going forward where you see that value more on a long term.
Okay, so it's a difficult one. I think I'm going to just maybe talk about sectors. So I think clearly, technology has been phenomenal. And I think the danger going forward is that to a large degree, a lot of the technology space is overvalued. And there's no justification for that in terms of a re-rating. So I'm going maybe slightly more contrary in terms of the beaten up sectors where we think there is quality. So US insurance, things like Arch Capital or Chubb, leisure in the US, companies like Disney, Crown Resorts in Australia, great casino group, Madison Square Gardens, Vail Resorts, which is the big ski resort owner in the US. And then maybe the last one would be US healthcare, names like HCA or Cigna, which have also actually been beaten up, not so much by Corona, but actually the political infighting between Biden and Trump. And these are great long-term quality business with huge cash flows that have derated recently. So those are the kind of stocks we would go for. If we could obviously pick up some of these technology stocks much cheaper, we definitely would, because I think long-term it's a great place to be. But the rotation trade, I think over the next 18 months is where the opportunity set is going to lie. It's not in Amazon and it's not in Microsoft and it's not in Apple at very elevated levels right now.
Fantastic. Howie, do you have a question?
Yeah, Jared, index funds are very popular within South Africa, but internationally the markets are looking quite overblown at the moment. Would you ever think about putting money into a NASDAQ or a FTSE index fund at this point?
Definitely. It very much depends on clients. The way we manage money, we have various portfolios. We have direct equity investments. We have our global equity fund, and then we have a multi-asset portfolio allocation, which deals in low-cost ETFs as well. So we have everything for everybody in terms of that. And clearly, you know, over the last few months, just buying indices as opposed to individual stocks has actually been very beneficial, because you've had the likes of a band of, you know, 15 or 20 stocks that have led this market. And if you haven't been in those stocks, you would have underperformed, yet the benchmark index has actually picked up that performance. So it's not a bad strategy. And certainly over the long term, you know, Buffett's put all of his family wealth actually into ETFs. There is a place for ETFs in the future, but we are intrinsically active fund managers and active investors. So, but it is a good strategy, and I wouldn't put anyone off putting money into ETFs.
There are a few shares that you've mentioned that may be overvalued. So let's talk about things like Apple. Yes or no?
So Apple, no. It's been a bugbear of mine because we owned Apple and we sold it, and we've bought it and we've sold it. But my thinking behind Apple is quite simple. 2 years ago, Apple used to trade at a discount to the S&P. S&P used to trade on, say, 15 times. Apple used to trade on 12 or 13 times. And what's evolved over the last 2 years is not much in terms of earnings growth of Apple. If you actually look at the year-on-year growth in terms of earnings, it's been pedestrian. It's been low single digit. So all they've done is they've bought back stock. They've financially engineered. And I still think if you look at their business model, 70% of their revenue is still generated from what I would consider commodity, i.e. their iPhone. So yes, there's services and there's a whole lot of ancillary things that are happening right now, and the whole halo effect. And I get that, and I get the cash flow, and I get the huge amount of cash on their balance sheet. But if you look at the stock now, it now trades on about, 30 times multiple. So it's double what the S&P is trading on, yet their earnings growth is not there. So for me, I just can't go there. Yet I understand why the market buys it, and people are still very bullish on it. But I would, compare that to a company like Microsoft. Microsoft does grow its earnings by, mid-teens. At least it's a growth business that you can kind of justify maybe on a peg basis. So we are comfortable owning something like Microsoft. But I think Apple is overvalued.
So the last question from my side: if you still had your bar mitzvah money to invest, would you put any of it in Tesla?
Definitely not.
Okay, where would you put it instead? Give us just one stock, your favorite.
Too difficult. I'll come back. Give me a few minutes. I'll come back at the end of the show. I'll give you an answer.
Fantastic. While you think about it, Dino, we want to thank Credo for sponsoring.
In fact, Howie, I've got an answer. I'll take a bit of a flatter and put it on a company called Flatter, which is Paddy Power Betfair. It's now called Flatter. It's an online gaming company listed in the UK, FTSE 100. The opportunity there is US sports betting, which is, it's a massive market that's opening up right now. There is UK regulation that's being put pressure on the stock, but we think they are number 1 or 2 placed in terms of gaining market share there. And I think there's a company that optically looks quite expensive, but I think from a growth perspective, can compound extensively over the next 3 to 5 years. So I would probably buy some Flutter.
So while you're fluttering there and talking about some of the SIN shares, we had a question a little earlier. What is your view on British American Tobacco and Richmond?
So I'll give you a view on, so we own Imperial Tobacco in our fund, and it's been a terrible performer for us. So I can talk more about Imperial and BATS. I don't really follow BATS, but it's the same methodology. Now, these businesses structurally are in decline. Their core business of old cigarettes, dropped by between 3 to 5% a year. And that makes up the main portion of their business. And then what everyone's hanging their hopes on is what's called next generation products, the vaping and what's not. In the case of Imperial, they are way behind the curve in terms of getting any traction. And on top of that, you have regulation that keeps coming in, that's putting pressure on next generation. Whereas before, the FDA was actually quite positive in terms of pushing smokers away from old cigarettes to next generation. One of the byproducts is that you've had teen smoking that's gone up massively, and that's what's put pressure on the sector. So I think both of these stocks, particularly in the case of Imperial Tobacco, the stock trades on about a 7 times PE on a dividend yield of about 9%. They may cut that even more, but they've got a new CEO that's just come in there. So that is a true, ugly value investment. The problem is that it is structurally in decline. But the way I look at it is if you look at the terminal value of Imperial Tobacco, the cash flows that you'll generate out of this business for the next 5 to 7 years will basically pay for the price that you're paying for the stock right now. And there are levers that the business can make. They're talking about selling certain sectors, the cigar cigar section, which actually has just been sold. They've got a logistics business they can sell. So there are levers they can pull. It is quite highly leveraged, but that is, that's the ugly stuff in the weeds that you've got to go and take a contrarian view in. I think it is one of the only stocks on the FTSE that gives you a really decent yield, but it's a difficult one. And I think, as I say, structurally, these businesses are impaired and they're not going to improve massively unless they get the next generation product up and running. And there've been teething problems with it. You've had overpayment for some of these businesses and we just don't know where it's going to go. So, I think I wouldn't be betting the house on tobacco, but I certainly have a portion of the portfolio in there, and we do in our fund and in our best ideas portfolio. So I would stick with it for now.
Jared, we're going to come back to you on the panel and ask the panelists some very interesting questions because you described something as in the weeds. So we're going to be asking questions about whether if anyone has invested in the marijuana sector as well as in Bitcoin. And we're going to do that after we have a sponsorship message from Credo. So a huge thank you to Credo for helping to sponsor tonight's broadcast. Cool. We'll be ensuring that when we send out the details of this broadcast tomorrow, we'll put in everyone's details. We've had so many requests for contact details for Sai at 361, for Steve Herring at his property fund, for Chris at Investec, and for Credo as well. So we'll make sure that all the details, in fact, get sent out tomorrow when we send out to everyone. But with that, can we ask everyone to turn on their cameras? There have been so many questions, Dina, that have come in this evening. We've had about 60 questions still piled up and waiting to be answered. So can I go first? And I want to know from all the panelists, I want to know if any of you have in your personal lives invested in Bitcoin or cryptocurrency.
So I'm happy to go first.
Please,
I have done in the early days and not in a big way, just to really see how it works. But if you ask me whether I'm a believer in Bitcoin, I'm definitely not.
Yeah, it would be interesting to see if anyone on this panel is, because I think everyone on this panel does use general fundamentals to kind of figure out what to stock pick. So, Sai, I think you'd probably be with the majority over here. Are there any other comments?
Well, Peter was a tech entrepreneur, so let's hear from him.
I'll go next. It's I mean, from a wealth management, looking after people's money perspective, we would certainly, if given a discretionary mandate, never invest in Bitcoin. We're very fundamental investors and want to know what the underlying value is. There is no underlying value. A lot of it is conjecture. From a client perspective, obviously a lot of our clients want to, think it's the next big thing. We don't discourage them from having a few percent in it. It is the new world. There's a lot of arguments either way, but I've never put a cent into it. And certainly in the early stages, we had a lot of people coming into our offices. We invited the so-called experts to try and explain it to us. I think for us, the blockchain is an interesting idea and something that can potentially change the world. But the currency aspect of it is something very different. And if it's going to be a store of value, the volatility of it certainly doesn't support that. So we watch it closely. It's an investment instrument. It's kind of a quasi currency. But something that, we always just go, if this thing went down 80% or to naught, we wouldn't really be able to explain properly why we invested in it. And I think the risk versus return is something that worries us.
Great.
Chris, do you have any of your personal wealth in cryptocurrency?
I'm afraid I'm not different from any of the others. I haven't invested any. And the fundamental issue I have with it is, if it is going to be a medium of exchange, you would think that the transaction cost should decline the more people use it. It should become more efficient. But it goes the other way around. The more people use it, the greater the transaction cost per transaction, which implies that there's some limit to the scalability of distributed ledgers in general. So we've looked into it to the extent that we understand it. We're not interested, and I certainly haven't invested any at this point. So I've missed out on the rally, but I'm happy to do so.
Dina, I want to bet that Steve has not, but my sense is Jared put a little money in. Should we find out if that's true?
I think I'd probably go with you, Howard, on this one. I think Jared's smiling too much.
Steve?
Yeah, you're spot on, Howard. I never have, and I never will put a penny into Bitcoin. In fact, I won't be surprised if one day it goes down to zero. I mean, it's like, for me, there's no value there. There's absolutely no value.
Jared, is Jared the contrarian on the panel?
How much are we betting?
Not my Credo portfolio, that's for sure.
I've changed my bet. The answer's no. I don't think Jared's.
Okay. Dina, I told you we're conservative investors at Credo.
That's why I said I don't think you have.
So the answer is no. We, like everyone, we looked at it. We had experts came in. We had some very sophisticated clients of ours actually invested quite early and made a fortune out of it. But lack of transparency, the fact that you can't open an account in a safe jurisdiction scared the life out of me. Ukraine, Iceland, Japan. It was very esoteric. It remains very esoteric, and it's not an asset class I actually understand. And we've always told clients who want to invest, here's the number of an account manager. Good luck. Go and do your own thing. And that's really the way we feel about it.
Dina, can I ask one more question, and then I'm going to get out of your hair and you can ask all the others. I want to know about the marijuana industry, because that's a big new industry. There seem to be a lot of South Africans in particular who've put money into firms in Canada, into places like Lesotho. Can we start with Sai? Is that something that you've looked at all?
We've looked at it offshore. I must say we don't know the space well enough. There's nothing listed in South Africa, so obviously we can't do that. And we don't do private equity. And we've been offered a few in our personal capacities, investment opportunities, and too difficult for us to understand. So I would leave it to the others.
Peter?
So I think when these things are really pumping, one of the guys in our office made the joke that, when things are reaching new highs from a marijuana perspective, you should stay away from it. I think ultimately, if you take an industry and the end of it, if this thing was to really take off, it's a kind of a farming and pharmaceutical business. So you'd put that kind of PE multiple on it. I think when something's in an early growth phase and certain people have got licenses and there might be a differential between supply and demand, margins can get high. But ultimately, it will revert. What are we looking at? Is there a moat around the business? Is there a competitive edge? We don't believe any particular player will have that. And so I mean, it raced away very quickly. These kind of big global growth trends move quite quickly. You're either in them in a 6-month period or you're not. We certainly didn't play in that space. We ultimately quite conservative investors, and want to make sure we're looking after people's capital. Is there a future in it? I think once it's stabilized, if we could find businesses with, you'd kind of have to start comparing it to the tobacco industry, I guess, and look at the multiples and growth rates. We ultimately look at companies bottom up to look at their return on capital, their underlying growth. Farming businesses don't attract high multiples. It depends where you are in the marijuana chain. If you're sitting in the farming category, you have to compare it to kind of farming and agriculture type businesses. If you're in the medicinal end, perhaps you could generously apply kind of a pharmaceutical multiple. But I think the bottom line, we've avoided it, but it's something we watch with almost a kind of novelty value, I guess.
Dina, do you think the grass is greener in the UK? Should we ask Jared?
Apparently it's greener in Swaziland, but you're welcome to answer the question.
Right. So Howie, we did look at it initially when the hype all came out, because again, the industry is massive. If they get it right, the dent that it could have on the beer industry and the smoking industry and the pharmaceutical industry to a point would be significant. But like all business plans, they're not very well thought out, and you have these very smooth talking Canadians who come across the water with these plans, and they say, we've got a license and we're just going to grow it here, and then we're going to retail it there, and we've got the product and we've got the brand, and it's all going to come together. And they raise the money, and these things go to the sky, and then what happens is there is absolutely no execution, and that's what has happened. And there's been some horror stories in terms of some bad stuff that's happened in terms of people not being able to make their production quotas and actually going on the illicit market and buying in production, and so on and so forth. So the industry has become a little bit tarnished, but more importantly, just all the expectation that was built into the sector just hasn't come through. And there was a time when we did have a crisis where there's also an issue in terms of US investors can't invest in the Canadian stocks unless they are medicinal. So they have a lack of access, pension money access to capital. It only comes from the private punter. And once that private punter becomes burnt, they're not going to keep funding these businesses. And they're all did start running out of money. And they've all started merging with each other now, and they've now got new funding together. But it is the Wild West. It really, truly is. And we have stayed away from it. Again, we like good quality, solid businesses where we can see cash flows and earnings, and we try and stay away from the blue sky stuff. So interesting space, but we haven't played in it.
Dina, we've got about 10 minutes left for more questions, so I'm going to leave those all to you.
Okay, listen, there's a fortune of questions, so we'll try and get to as many as we can. If starting out as a young professional where your capital is somewhat limiting, does an investor in hedge funds need substantial capital to invest, and how long should one keep the investment in a hedge fund for? Sai, I think you are probably the best place to answer that.
Yeah, the great thing what's happened in the last few years is hedge funds have been incorporated under the same legislation as unit trusts. So we now have a unit trust that runs effectively pari passu with our main hedge fund. It's a daily unit trust. You can put money in any day. It's got very low minimums, I think a few thousand rand. You can add any time you want. Looks like Arsenal just scored. Sorry, I'm a bit upset. I'm a Liverpool supporter. And it's 1-1 for those interested. But I think for the investor, it's become very available to everybody. I also saw some more questions on the web here about how much money do I need for a hedge fund. The old days used to be R1 million minimum. Today, it's almost the same as any other investment, and it's very affordable for retail investors.
All right, and
as far as the time horizon, well, it depends. I think the time is good forever. I mean, you don't do anything like this for the short term. We've been invested in our own hedge funds for 15 years. I've never sold a single unit in any of my hedge funds, nor have people who work with us, and many of our long-standing clients who joined us from years before 361. Have never sold out and stay invested. And I think as long as you don't need the money, you stay invested.
Absolutely. Thank you. Okay, next question. What are the chances of very high inflation taking place in the next few years because of all the money that's been pumped into the economies? And if so, what can the retail investor do to protect his or her assets? I think, Chris, do you want to take that?
Yeah, absolutely. I think there is a sizable risk. Ahead of the global financial crisis, there was a massive increase in money supply, just like we've seen now, but there wasn't inflation. And as a result, there's a school of thought out there that this time there again won't be inflation. I think the difference is we're seeing a much greater growth in money supply. As we mentioned earlier, in the US, it's up 25% year on year. That's the first point. The second is the global financial crisis didn't have a supply shock. We currently have supply chains that have been disrupted around the world. And once demand starts to pick up, and there's evidence that it's doing so already, we will see this increase for demand. And we think in many cases, supply won't be able to meet that. So we will see, in our view, an increase in inflation. Now, traditionally, the way to hedge that is through hard assets, commodity types. So gold is an example of that. Equities do better than bonds in an inflation environment, but they don't do very well when inflation picks up initially. So it's more through your commodity plays, which are either your resource type counters or commodities themselves, an example of which is gold.
Okay, thank you. Okay, now there are two questions that are quite similar, so I'm just going to put them together. It says, what are the panelists' thoughts on the current status of the NASDAQ and the Dow? Currently, PE ratios and valuations definitely don't reflect the COVID carnage that hasn't yet reported in financial statements. So I think that is very true. So as we've seen, there's been a complete correction to pre-COVID levels. Peter, do you want to take that question?
Yeah, I think we talked about some of it in the chat we had earlier. I think, I'd kind of replaced the Dow with the S&P. The Dow is almost kind of an irrelevant index the way it's constructed. So I think, as we explained, you've got really two very distinct portions of the US markets. The one is the stay-at-home high quality businesses that will benefit from the acceleration in trends. And those are up, as we showed you, about 20% in aggregate. And then on the other side, you've got the companies that, will take a longer while to recover, the US financials, etc., which are probably down 20% in aggregate. So looking at an index as a whole, I think can be a little bit disingenuous. If I was to sketch my kind of baseline expectation of where we go from here, I think, the tech shares have run very, very, very hard and fast. I think their long-term trend is in place. But if I was to put my own money on the table right now, it would be a rebound in the companies that are still down 20-30%. If we get a vaccine, economies recover. What we've been saying to our investment team back in the office is what companies will be the same in a year's time as they were 6 months ago. So, we've just had a temporary blip. You can buy them cheaply, and that's kind of where we've been adding focus and adding attention and adding investments. So a rebound in those type of shares, like a JP Morgan, they're not getting wiped out by the crisis like they were in 2008. The price is down 20%. We think that can come back reasonably. So probably a dip in those, and then a reversion to the long-term trend of the tech shares outperforming, because as a few people have alluded to, those big tech companies are growing their turnovers at 15 to 20% per annum, whereas the average US company is growing their turnover at 5 to 6% per annum. So you want to be in the companies where the long-term trends are in their favor. We are ultimately valuation-sensitive investors. So a lot of what Jared says resonates with me. So we're not going to touch something like a Tesla, but we have stretched our imagination a little bit with the tech shares, and kind of dreamed a little bit of what they can become, which has worked in the short term. But we'd probably be a little bit more conservative now.
Great. Okay, I think we've got time for like 2 or 3 more questions. So I'm going to go into the next one. These are questions that have been voted up to the top of the list. What is your panel's call on a recovery in Redefine? I think our property guru, old Stephen Herring, should take this one. Where do you think Redefine's going?
So Redefine, I think went up to 11 or 12 Rand at one point. But during the last few months, it crashed and went below 2 Rand, which was its original listing price 20 years ago. Their leverage was a little bit high, but they've started to get their balance sheet in order. They've sold off their student accommodation in Australia at quite a significant premium to their NAV. They've also sold out of their shares in Redefine International, which is listed in London. So I think they've disposed of about 8 billion rands worth of assets to get their gearing in order. The shares bounced back from those lows of about 160, 180, and they're sort of around R3, R3.50. I still think it's cheap. I still think it offers good value. If you took a 6 to 12 month view, it might go sideways, but I think in the medium term, it's a good buying opportunity, and it's highly liquid as well.
Great. Okay. And the last question, which actually has come in a few, is my mother has around R1 million to retire on. What do I do with it? I think that is a golden question, because I think a lot of people are looking at their retirement. They've got limited funds. Are there any volunteers on this question?
I'll have a go with that. I think if you're looking at conservative money, as we showed right early on in our presentation, South Africa is quite unique in the world in the real return you can earn out of low risk fixed investment. So, like our bond funds yielding about 9.5%, our flexible income fund about 7%. It's similar to kind of market norms. So I think the opportunity to compound, if you've got a smaller amount of money that you need to live off, you need some income off it. South Africa offers quite a rare opportunity to earn quite nice yields going through. So to compound it without taking massive risk.
Great, thank you. And there was also a question. So also I have to apologize. Alan Denby was supposed to be on our panel this evening from the SA Gold Coin Exchange, but he had some power issues, unfortunately, which we do have in South Africa. So I do apologize that he was not part of our panel, because we do have a question here on Kruger Rands, and are Kruger Rands a good buy? I know we had talked about gold and gold stocks as a rand hedge, but is the actual bullion itself valuable and worth buying for the long term, with a long-term view as a safe haven? Peter, I know you mentioned it earlier, sorry, in terms of the gold. Would you say that it is or that it isn't from a Kruger Rand point of view?
Really hoping Sa would take that. So I think there's a bit of a...
All right,
I'm happy to take it.
Sa, would you like to take that?
I'm happy to take it. So, I think there's a view at the moment with the amount of stimulus that's being pumped into the world. It's unprecedented that gold will remain, in our view, quite a favorable asset class. As Peter's mentioned and others, Chris, before, rates are exceptionally low, which I think leads to a favorable gold position. I'm also not long-term a real believer in the currency strength in South Africa. I know we have real rates, and for the moment, emerging markets are in a stronger position than the US, due to the stimulus that's continually happening, specifically in developed markets. But I think that's going to be a medium to short to medium term problem. Longer term, I expect weakness in the currency, and I expect the gold price to remain high. So it is an okay investment. It obviously doesn't pay you a dividend yield, but I think as a portion of your assets, it's a great asset to hold. If all your money is in only Kruger Rands, then I would say you need to diversify, because it doesn't give you an income stream. But we do like it.
Great. Okay, so that's a thumbs up for Kruger Rands. Okay, now the very last question. Amazon are taking over the world. How do you think businesses compete against them, or don't they? Is it to find the niche and disrupt where Amazon can't? Jared, Chris, who wants to take that one?
I'll take it. So, clearly Amazon is an incredible beast, and we have, unfortunately, and sometimes fortunately, run into situations where we've had stocks, for example, in the auto parts sector, where great company, AutoZone, next thing Amazon says, we're going into that space, and the stock sells off 25%. Same in the healthcare sector. They're forming alliances with various healthcare businesses. Cigna is a business that also trades in that space. And instantly businesses sell off when the threat of Amazon comes into the space, because they have the power, they have the cash, and they have the technology. But I think what is clear is that these very specialist businesses, have been around a long time, and it's not so easy for Amazon just to come and take market share in the space. So I wouldn't want to bet against Amazon, let's put it that way, because they are disruptive and they have a model that is grab market share at any cost, whittle down your competition, and then build up from there. But they have failed on many occasions, and I think you've got to tread very carefully and very lightly in the spaces that they do come into, and you've got to do your homework. And I think, as the caller says, you have to pick the niches where they can't actually participate.
Well, it seems like few and far between at the moment because they do seem to be taking over the world. All right, so I think that's going to be our last question, unless there's anything that any of the panelists would like to add that they feel we haven't covered and that they feel is absolutely essential for our viewers to know. I think we have covered a lot of ground tonight. I think we've looked at a lot of different sectors, a lot of asset classes. And yeah, I think you've all done very well. So I have to thank all of you. We know your time is all very valuable, even though you're all in different parts of the world. So we do thank you so much for your time. I know Howard also wanted to add something in.
Dina, I just wanted to thank not only the panelists, but really, literally the thousands of people who've watched us this evening. So we'd love to know from you if you found tonight actually useful, if you found it interesting, if you think there was good advice that you've heard. So please use the chat section. Let us know whether you enjoyed this evening. Let us know which of your panelists were your favorite. Let us know which pieces of advice you really found the most useful this evening. But Dina, I can't help notice that our panel tonight looked very male.
Yes, indeed. So it actually, unfortunately, was not on purpose. We did have two unbelievable women in the sector. We had Magda Wierzeska, I can never do that pronunciation, and Zmira and Mulasa from Signia 91 that we wanted to have on this panel. Unfortunately, neither of them could join us, but they are literally superstars in the sector. So we will make it up in August, which is Women's Month, by having a power women's session with no men. So I do apologize if there was some sort of lack of diversity on this panel, but I think that our panelists did themselves all very proud. And even though there were no women, we know that we will get it back in August.
We'll be back in about 15 seconds time. We have one last advert from North Face Capital, who are huge sponsors of this evening's Zoom webcast. So let's just hear one last word from North Face Capital. And that's true, Dina, because tough times don't last, and we will return to a normality. And with that, and a huge thank you to everyone involved tonight. Let's remind everyone that, in fact, we have two big Zoom events coming up in the next few days. Do you remember what we have on Saturday night, Dina? Mandela Day.
Absolutely. We are going to have LB Sachs and we are going to have Rory Stain as our headline speakers, talking about their experiences, obviously, with apartheid and with Madiba himself. So I think that is going to be phenomenal. I can't wait to hear that story. I think LB has just got so much richness in his stories and what he's experienced that it's just going to be a phenomenal, phenomenal talk. And Rory himself, literally defending the man himself, Madiba. I think his insights are going to be literally outstanding for all of our viewers.
And next week, Thursday, the 23rd, we're going to be having our Father evening. So we're going to, in fact, play out just with the advert. Thank you to everyone for participating tonight. A huge thank you to all of our panelists. Tonight's recording will be available on YouTube for everyone to watch and continue to watch. And we'll send out a recording of this to everyone together with everyone's contact information, the slides you've seen this evening. Thank you so much for joining us, and we'll see you again on Saturday evening.
انت جاي حفله ليه لا؟
بفكر في الموضوع.
מעניין שאבא וגם החוט שלו עשו לנו פוטוגרפיה. מדובר פה בלוחמי קומנדו מאוד מיומנים.
אנחנו יוצאים לפעולה משותפת במיאמם. זה לכם ברור, חברון זה לא שכם. Welcome to עזה.
اليوم بكسرك. في الخط جايبي وريحته طالعه.
كيف قطعته؟ البحر.
And to Dan Stillerman, the Chief Investment Officer of all of our Zoom sessions. Dan, thank you for everything that you do for us. Thank you for putting on, it was a difficult evening. You put on so many videos, so many advertisements. Thank you for making sure that everything ran so smoothly, so efficiently, and so professionally.
Thank you, Howie. Always a pleasure. Very interesting stuff. And yeah, looking forward to Saturday night. It's going to be fascinating with LB and Rory. So excited for that. See you then.
See you then. But before then, Dan, take your pocket money. Let's go make an investment with one of these guys.
Let's go. Where are we going to go? We're going to have to do it from home with our masks on. No?
We'll do it at home from our masks on. I think Peter's getting 25%. Steve Herring's getting 25%. Chris already has probably taken 20%. Let's split it amongst them all. Dina, where's your bat mitzvah money gone?
I was going to say, maybe with Steinhoff.
Good night, everyone. See you again soon.
Well done, guys. Thanks very much.
Cheers.
Thanks so much.
Cheers, everyone. Ciao.
Everybody.
Bye.